Sunil Subramaniam is the Deputy CEO at Sundaram Mutual Fund. He joins us. Thank you so much for joining us. Good morning, Mr. Subramaniam. What are you? What is the fund being able to buy at times like these? Is there any value left anywhere?
No, there is. See, we all tend to get dominated by the Nifty and the Sensex in terms of the movements, right? But if you look at the broader market, the BSE 500, the mid-cap index, the small-cap index, there's still a huge amount of undervaluation relative to their own highs. The narrowing in gap between the Sensex and the mid-caps has happened to some extent. But if you go back and see that Sensex stocks and Nifty stocks are essentially largely liquidity driven with some amount of fundamentals in it. But if you see the mid and small cap, it's more the country's economy, the GDP growth rates and the recovery of the broader demographic oriented demand and consumption story which drives these stocks. And so there is a huge amount of opportunity left because there's a huge wide, at least about 1,000, 2,000 stocks where you can play in. So we remain bullish in terms of investing into the market with a long perspective.
But even if I look at the mid-cap space, it's just about 10% and in some cases actually has caught up with the 2008 highs, right? They're just 10% odd away.
Correct.
So the upside, what is the upside even there? I mean, in 2008, the mid-cap counters were completely overblown. Right? So those valuations were completely out of whack, right?
Yeah, I agree. But if you look at the mid-cap index and the range of stocks available in sectors, is the overall index which is looking closer to the earlier highs. But if you look at those kind of sectors which are going to do well and which are going to post very healthy growth in EPS and profits over the next few years, those counters are still significantly undervalued. And so if you move down to the small cap index, for example, forward FY15 earnings are only quoting at 12 PE and the peak of the small cap was 20. So there's still a 40% discount. The why diverting attention from the mid cap to the small cap is because of two things. One is the mid caps have risen in the short run because of the flow of liquidity into the economy, right? But if you see the core earnings, the broader economy is represented by hundreds and thousands of suppliers of cap goods, infrastructure companies, consumer cyclicals, consumer discretionary. So the range of companies which are there. So if you compare index to index, the composition of the index then and now, there could be significant variations. So overall, yes, those counters where money has been flowing in due to liquidity reasons are seeing a narrowing in the valuation gaps. But if you look at those companies which are expecting to do well over the next 3 to 5 years, there is still enough juice to buy and hold them and deliver very good value to investors.
If I look at your portfolio and there you have a fund called, I think, Sundaram Microcap, is that what the fund is?
That's correct.
Microcap. So that is the smaller end of the mid cap and even companies which are below 1,000 crore market cap, right?
Not 1,000 crores. It's a definition of the microcap is the 301st stock on the NSE. So that today is about 3,600 crores in market caps. So it's not, microcap doesn't mean below 1,000. So even there, the weighted average market cap of the fund would be in excess of 2,000 crores.
All right. No, I'm looking at the counters themselves. Each of those would, because I'm looking at some of the smaller ones that you have there. I'm looking at, for instance, Madhucon doesn't make the, some of them are quite small, right? There's Madhucon projects. Some of them are in the 2,000 crore rate.
Bottom limit.
Sorry?
Yeah, see, the reason we buy a stock, Prashant, is in terms of the ability of that company to benefit from the cyclical upturn in the economy, right? And so we are actually picking those stocks and sectors which are going to show outsized EPS growth and performance. Market valuations will catch up later when they actually see the demonstrated effect. But thanks to our research, thanks to the fact that we have a 12-member analyst team which goes and meets these promoters, visits their plants, there are about 260 stocks that we cover on our own. We are able to identify these stocks well before the market valuations catch up. And that's the beauty of the launch of these funds. So you mentioned the microcap. We started launching this microcap series in October, November, December last year. And if you see on a return basis, they have given excess of 80% return over the last year. So obviously those picks have done well. We have picked them early and market is now discovering them. But you'll see that, over a 3 to 5 year bull run, this 70-80% return on a 1 year basis is nothing. Because these kind of cyclical sectors have shown multiplier valuations in terms of 8x, 9x, 10x over 3 to 5 years if you take the previous bull run into account, which was I think April 2003 to Jan 2008. So our point of view is we buy the stock based on its potential, which comes from the sector, and we don't necessarily buy a sector and then go bottom up looking for stocks there.
All right. And, when we had you last time, we were going through some of the counters in your portfolio, and I'm seeing some additions there. I don't know if you're comfortable talking about them, but I'm seeing that you've now started also looking at some white goods, some specific consumer products. Is that a upcycle that you're looking at?
Yes. You see, if you look at the typical, we see the economy as moving from a vicious cycle to a virtuous cycle. So what happens is there are various legs to the recovery. The first leg of recovery happens from those companies where the capacity utilizations are very low, and they are the ones which rise fast in terms of better asset turnovers. The next leg comes from the fresh capex being done, and there are companies which supply to these. So the infrastructure boost, the roads, bridges, ports, companies which supply to these come into the next leg. Then the third leg is the interest rate sensitives, where you see these consumer cyclicals, you say interest rate sensitives, all of those consumer discretionary go up. So like I said, we'd like to buy early before the market as a whole identifies these as potentials. So we are seeing the green shoots happening in these sectors, and so we have started accumulating in these sectors good quality companies.
Okay, I'm just going to throw stocks at you which are in the public domain. They're published on your website. So I'm not going to ask you for things that you're doing now in September, but whatever you had in August 31st. And just give us our viewers a sense as to what is the logic behind investing in them. As I said, they're in the public domain, so therefore
I just say that
they're in the public domain.
We generally don't talk about our stocks.
But they're in the public domain.
We don't talk about our stock picks. No, every stock is in the public domain if it's listed, no?
No, I'm saying it's in the public domain in terms of your portfolio. It's out there. Around August 31st, this is what you have.
No, all of our stocks. See, we are one of those few full disclosure companies. So our fact sheets every month disclose our entire portfolio. That's why I said, so our entire portfolio is in the public domain. So there's nothing that we have bought is just not in the public domain.
No, I just want to understand the logic. That's all. I mean, we are not saying give us why you bought it.
So then why don't you do one thing? Why don't you look at it in terms of sectors and ask me? I'll be much more comfortable answering it on sectors rather than stocks.
That's fair. Okay. That's absolutely fair. So and the microcap space I was going to ask you, it's not divided into sectors, so I'll do something else. I'll look at the equity multiplier, and there I see that your financial services is where you have the maximum weight, right? Almost 1/4 in the equity multiplier is financial services. So is it because you think that any growth story is actually the best to enter it is through the financial services space?
Yes, I agree with you there. We are very bullish on the financial services because financial services has three legs to why they do well. Okay, the first leg is banks, which are a dominant player in the financial services, right? Are the ones which are going to support the financial pickup through the demographic. So if you look at it, as you have a growing middle class, you're going to see much more money flow through the banking system. The government's boost to the other program is going to make sure the banking system gets free float in terms of money which lies there while the customer picks it up. So banking as a sector in an underbanked country like India, with financial inclusion a strong thing for the government, is going to benefit from terms of increased money flow from the grey market into the pure white market. That's step one. Step two is in terms of lending. When all these, when the cyclical stocks recover, when economy recovers, there's a huge need for funding, both for working capital and for financing infrastructure. And you all know in the budget what the government announced in terms of SOPs for the banking sector when they finance the infrastructure segment. So there's a huge boost to their NIMs coming from the increased lending at higher rates which will come in. The third leg to the banking story comes from the interest rate story, right? Banks hold something like 30% of SLR, which is far in excess of what the government mandates, all on their books. So when G-Secs prices start, flattening out, when interest rates start recovering, there's a huge amount of gains to these banks' portfolios from the trading G-Secs that they hold. So there are three legs to the banking story, and we believe that the NPA thing, because of the high conservative provisioning norms that we've adopted, that there's only an upside on the NPA which will come through when the economy recovers.
Mr. Subramaniam, looking at another fund, which is the Smile Fund.
Yeah.
And there, has the exposure to automobiles actually gone up slightly compared to last month?
We have turned increasingly bullish on the auto because we are seeing recoveries happening in the two-wheelers and the cars recently, and we also feel that the tractor segment, commercial vehicle segment, the slowdown is now getting arrested and there's a boost there. So we are bullish, and Smile, thanks for mentioning it, because it's a fund where we have played, because it has an ability to go into the small, mid and large cap if need be to a large extent. With about 70% plus in cyclicals, it's delivered about 124% return over the last 1 year. Okay, so clearly we have got onto a good wicket in terms of picking the right sectors and stocks there, and these are delivering very good value for our investors.
Okay, I'm going through some of the funds, and the last time you came, the data we had on your website was for, I think, end July. Now we have August end. And to me, it looks like some of the funds now have more cash than they had in July. What would the reason be for that?
I think that's just a function of the fact that we got in a lot of inflows. So inflows have been healthy. And so it's just pending deployment. So it's otherwise we are bullish and we intend to be fully deployed. So that's just that since the inflows come in at the end of the month, they have not yet been deployed. So it's not reflective of any valuation related, moving into cash kind of a story.
But you're saying essentially that in end of July, the kind of inflows you had was less than what you have in end of August, and therefore the cash amount relatively higher?
Yeah, I think the opposite. It's the flows have been increasing month on month.
Yeah, that's what I meant. So that at the end of August, you have more cash, and therefore it's showing up as more.
Yes.
All right.
That's also true. Plus, I think as a fund house, we had the Microcap. We had a successful closure of our Microcap Series 5, which raised about in excess of 125 crores in cash. So that money is also lying with us because we will deploy it only in the month of September.
Mr. Subramaniam, good morning, Prashant here. So just to stick to that point.
No, sorry, I didn't realize I was not talking to you. Okay. Sorry. Yeah.
August, so just on that point, inflows point, right? Inflows in August into mutual funds, equity mutual funds, is about $850 million. July was 1.8, June was $1.2 billion.
Correct.
These are flows into equity mutual funds. But if you look at what mutual funds in turn are doing in the market, but we get the DII number, the domestic institutional investor number, which includes insurance companies also. So where is that selling coming from? Are mutual funds net buyers and insurance companies are selling?
No, you see, I think insurance companies are selling. Plus mutual funds, you're looking at the gross inflows, but there are redemptions also. So you look at the net number, is much, much smaller. You looked at gross flows. So you look at net flows, there are also redemptions happening.
Yes. So, but redemptions, that's how much are redemptions, etc., are kind of hard to tell, right? Because funds would be selling for.
From the
I don't think AMP puts that number out. But what would you say? So out of 800, what I'm saying is, what percentage would be redemptions and what would be actual profit booking by funds, or actually selling something to buy something else or whatever?
So the reason for the profit booking could be two also. So the one is redemptions, second is profit booking. But profit booking to pay out dividends is one, profit booking to reallocate the portfolio is two. So if you ask me, they'll roughly be equally divided in terms of 30-30-30. So because the SEBI rules, see, a lot of mutual funds in our schemes, for example, we've been giving out a lot of dividends. We've given out 20 dividends over the last 15 weeks. So the SEBI rule mandates that you have to actually book cash profits before you can pay dividends to your dividend investors. So we have to actually sell the stock in the marketplace. So that mandate makes it that suppose I want to declare a dividend in my mid-cap fund, for example, then I have to actually go and sell stocks to the value of the dividend and show the cash profit. So this kind of a selling is something compulsorily which we have to do because we'd like to reward our investors because when they come into the dividend option, they expect us to book profits at regular intervals and pay them back as dividends. Right? So this is not necessarily reflective of a view on the particular sector or stock as much as a need to generate the cash to pay out dividends.
But you're saying
so
it's 30-30-30.
40% would be from redemptions and about 30% would be reallocation of portfolios and payout of dividends for in the future.
Right. But the rate at which people are actually redeeming their units, that is still steady, or that has dropped off?
That is still quite high because
yeah.
No, you see, I'll tell you, the people who came in the 2006-7 and early half of 8 period, right? In many of the funds that they put their money, many of the stocks are actually only now coming back to par levels. So there is the investor who's waited for 5-6 years and sees his money back in the in the black would tend to redeem and get his money out and then look at a re-entry. Because if you see the fresh flows which you mentioned as a very healthy flows are still, I would say, largely from the institutional HNI and a little bit from the higher end of the MNI segment. The pure retail investors are just beginning to re-enter the equity markets. So there's still a lot of profit booking going on in the retail segment from people who have held on to their portfolios for, say, excess of 5, 6, 7 years.
Yeah. And how many of the schemes that Sundaram offers are of the dividend variety, or rather, what percentage of investors choose the dividend option? Yeah.
The ratio for us is about 52%. Every fund of ours carries a dividend option. We don't launch funds without dividend options. So everything. So if you look as a fund house as a whole. On the equity side, about 52% of our investors have opted for the dividend option. So,
okay.
Which means, you can do the calculation that I'll have to
I imagine as the market picks up pace, yeah. But as the market picks up pace and we really get to exuberant kind of levels, people would take on that, wouldn't take on the dividend option, right? I mean, that percentage will keep coming off.
No, actually, we're not seeing a big change in the trend. We are seeing that fresh inflows, the fresh NFOs that we've launched, maybe it varies between 48 to 52. But if you see roughly, the thought process of an investor when he chooses dividend option is more from his fundamental psyche and not based on the market valuations. So when a customer invests in a fund, if he's of the variety who thinks of mutual funds as something where he gets unexpected cash, where he can do a gifting of something to his wife, buy her a diamond ring, do something like that, they tend to go. Whereas those people who believe that this is risk capital and it should deliver best value in a long term and stay invested for 3-5 years, they tend to go for the growth option. So this is an investor psyche thing rather than a market valuation thing. So in fresh inflows versus existing portfolios, that ratio is not changing that dramatically.
Mr. Subramaniam, thanks very much for your time. Good talking to you.
Okay.
Thanks for coming on and sharing those details with us patiently.